Loud.
Awesome. It's official. Hi, everyone. Thanks for joining us. I'm Ilan Penson, a realtor with Red Oak Realty. Red Oak is an award-winning independent brokerage specializing in the Inner East Bay. We're women-owned, women-managed, and green certified. I'm here with Faramarz of Cross Country Mortgage, and we're really happy to have you join us for a look into the financial aspect of your home buying journey. So when you're starting this journey, whether you're a new home buyer or an investor, a lot of things need to be aligned. You need to be prepared financially and emotionally to move forward. As a realtor, I'll help you navigate the process, and as part of that process, connect you with the best resources. You need a rock solid team in your corner from start to finish, from getting your financials in order through escrow and everything in between. I'll act as your quarterback, orchestrating all of the appropriate connections for you. And so today's webinar, we're going to focus on the financial aspect of the home buying journey. Faramarz is the team leader of the FMZ team at Cross Country Mortgage. He's going to kick off our home buying webinar by sharing a brief overview of his background. I will start off by saying he is truly an MVP partner. Listing agents absolutely love it when they see Faramarz and his team as lenders, because they know if they move forward with the offer his team is underwriting, they're in for a swift, smooth transaction, typically offering just 14 days to close. So today we're going to look at the power of real estate as an investment tool, mortgage strategies, the crucial decision of whether now is the time to buy, and the advantage of working with the FMZ team and some local listings in the Inner East Bay. And with that, I'm going to turn it over to Faramarz.
Well, thank you. And that was fantastic. I'm so glad this is being recorded because that's my future commercial for everything. I appreciate you. It's nice when we work so hard at something and get recognized. So I really appreciate the kind
That's
words.
all true.
And it's a thrill to be on this with you. So you guys, a couple housekeeping things before we get rolling. So number one, this meeting is being recorded, and nobody's faces or likeness other than Ilan and I are on here, so you really shouldn't care, but just as a disclaimer, we're required to tell you that this meeting is being recorded. So there's that. If you have questions, you can put them in the chat or the Q&A. We're watching both of them. Q&A, we can kind of keep a record of it. It's a little cleaner, but if you do have any questions throughout, go ahead and type them in there. If I'm going, Ilan will jump in and let me know what the question is. And if she's going, I'll jump in and let her know what the question is. So feel free to use that chat or the Q&A box throughout. If you'd like a recording of this when we're all done, it's going to be recorded to the cloud, and everybody who's attending will get a link to it. Okay. So let's get rolling. So why are we here at 6 o'clock on Wednesday night? Well, we're here to talk about real estate. And some of you are first-time buyers who have yet to be pre-approved. Some of you are just starting your journey. Some of you are wondering, why would I even buy real estate? And it's a great thing to be talking about because in America, in the United States, there's basically 5 of the top ways that you can build generational wealth, family wealth for your family. Okay. And number 1 is you can inherit it. That's pretty easy. Parents did a great job, passed it right on to you, and congratulations, you're rich. This doesn't really apply to the top 1 or 2%, right? Second is you can start a business. Starting a business is great. It's a great entrepreneurial nation that we live in. Unfortunately, the vast majority fail within the first 2 years. So it's risky. You can do day trading, you can do stock trading. Again, very risky to time the market, very risky to go up against institutional investors. This one's my favorite. You could be an entertainer, you could be a star, but if you can't sing like Taylor Swift or shoot the ball like Steph Curry, chances are that if you're looking to build wealth, it's going to be through real estate. And the way that people build wealth through real estate is through moving up, right? By taking advantage of the appreciation that's inherently there. But a lot of people ask the question because they say, well, yeah, real estate's great, but how quickly does it go up? On average, real estate goes up about 6% per year in the U.S. And we're here in the Bay Area, and sometimes it goes even better than that, as we saw in 2021. But in general, over the last 50 years, it's right around 6 to 7% per year. And a lot of my clients ask me, well, why would I invest in real estate? I'm getting 9 to 10, 12% on my stock portfolio. And the answer to that is the power of leverage, right? It's the lending part of it that comes into play, which is really what lets you make money. Because take this example, $500,000 home, you put a 5% down payment down, that's $25,000 that you've used of your own cash. The value goes up 6%. That's a $30,000 increase in 1 year. You've actually made 120% return on your investment in this scenario. So it's not so much the value of the property, because very few people are buying all cash in real estate. They're using some kind of leverage by using some of their cash, but a vast majority loan. Even if you put 20% down, same scenario, $500,000 house, put down 100,000, 20% down, value goes up 6%. You're still crushing any other investment. You're getting a 30% annualized return on your investment. So it's extremely powerful. In addition to just the appreciation value, the tax code is designed around real estate ownership. So you're getting a lot of tax breaks when you own a property. You have the pride of ownership, the ability to shape and design your own environment where you rest your head every night the way that you want it. And you also have that security against your landlord showing up one day and saying, hey, guess what? I'm moving back in, or I decided to sell the house, and you have to move. So you know that you're going to be there. It creates a lot of family stability in addition to family wealth. So it's a great thing to do. So, and I'm speaking from experience. So my home ownership journey was right here local. My wife and I were engaged, and we bought our first home in 2000 in Oakland for $405. It was a tiny little house, less than 1,000 square feet. The pictures on the screen are not the actual pictures of the properties I owned. These are mock-ups here, but the prices are correct. So fast forward 6 years, now we're married, we've got a couple of young kids, and we're outgrowing our house. We want to get out of that neighborhood, and we moved to Montclair, where we bought a house for $825. We sold our house for $640. We had put 5% down. By then our loan amount was down around $360. All of a sudden, we had almost $300,000 to roll over into our next property and get about a 525-ish loan on the Montclair house. Then the financial crisis hit, and the value of what we had bought for $825 dropped down to about $750. But we didn't care. We weren't looking to sell it at that exact moment. It was the next year. I think I bought the last expensive house in Oakland in 2006, and then after that, everything recovered, right? We had a couple of down years, and then the bounce back was so intense that we were able to sell it 8 years later, 2014, for $1,150,000, roll over about $700,000 into a house that we bought in Orinda with an $800,000 loan. So there is no way that I could have, over that course of time, working, paying for kids, all the expenses that are incurred in the Bay Area, there's no way I could have put together $700,000 to buy a $1.5 million house had it not been for me just getting my toe into the real estate market in the year 2000. So, and this is not an uncommon story. I have literally helped, I don't even know how many scores, probably less than 100, but definitely more than dozens of clients of mine go on the same type of journey where they come to me as first-time buyers. They attend events like this that you're watching right now, get in, make a couple sacrifices. Maybe it's not the right size, the right neighborhood exactly, but hey, we're in, turn around, live our lives. 5 or 6 years later, we're rolling into a much nicer house that we love. Okay, so that's the deal. Now, we want to get a pre-approval. We want to get a house. This all looks great. I want to build wealth. Who do I work with? Well, there's a couple different flavors of lending out there. And I think it's important for you guys to all understand this, because it's not really something that is ever taught or talked about in any great detail. So we're going to cover it real quick here. There's basically 3 kinds of ways that loans can be what we call originated. One is through a retail lender. Name brand, you all know, wherever you have your checking and savings, Wells, Chase, credit union, whatever it might be. The second way is through a broker. Now, a broker is someone who takes your loan application and sends it off somewhere else to be underwritten and funded and handled, right? So they act as a conduit between you and the ultimate company that is going to be underwriting and funding the loan. The third way is through a correspondent or a direct lender. And this has become one of the dominant ways that loans are being done in the country. Cross Country Mortgage, where I work, is a direct lender. Guaranteed Rate, American Pacific, Supreme Lending, Fairway Mortgage. These are all examples of direct lenders. Difference between us and a broker: we work with you, we get your information, we underwrite the file, we fund the loan, everything stays under one roof. That's a big difference. So here's some details about the differences. So when you're looking at a retail lender, hey, it's a known brand, right? If you have a lot of money, over 500,000, $1 million sitting at a bank, they will literally lose money on the mortgage to make sure that you don't talk to any other institutions. So you can get really good rates if you have a ton of money sitting at a bank. They also have other relationship discounts. If you deposit tons of money into a bank, then they might give you some discounts on your mortgage. The downside in a competitive purchase market is that their service and turn times aren't that great. They don't just do mortgage. Mortgage is a part of their business, but they are doing checking and savings, wealth management, credit cards, all kinds of auto loans, all these other things, so that their focus isn't necessarily on mortgage. So when things get busy, they don't staff up and staff down real quickly. So their turn times and the speed with which they can respond to you might go down. Very, very conservative, very rigid underwriting normally at retail institutions. They're limited in their lending products. They like what they like. They don't want to go out of the box, and they stick to it pretty much. Generally speaking, you're dealing with somebody Monday to Friday, 9 to 5. You see a house that you love on a weekend on an open house. Might be tough to get somebody. I do know a lot of really good loan officers at retail banks who will work on the weekends, who will share their cell phone. So this is not universal, but for the, I'd say for the most part, unless you get one of these rock stars, it's probably the case. Because they're so conservative and because they don't really focus on mortgage and have their own appraisal management company, they order appraisals through national appraisal syndicates who don't pay appraisers really well. So in a lot of areas, a lot of the local appraisers will turn down these lower priced orders. So you go out to areas that are maybe 50, 100 miles away and batch orders together with an appraiser who rolls into town and does 20 or 30. They might not know the exact geography of a urban center like the Bay Area or LA or San Diego or something. Their capacity for fully underwriting approvals goes away when things get really busy. We saw this during COVID. And generally speaking, like I said, I know some amazing loan officers at retail banks, but generally speaking, you're looking at an entry-level loan officer type of position where the compensation is a little bit lower. It's a place to get your career started, but you don't have the expertise maybe that you have at different institutions. So then we go to broker, and brokers take loans and they send them off to Rocket Mortgage or United Wholesale Mortgage or any of these kinds of places. They get pretty good rates on conventional loans. They can shop them. They're lean and mean. They have the ability to shop at different wholesale lenders to try to find where might be the best rate. They're generally available on your schedule, where they don't just work 9 to 5 Monday through Friday. They're self-employed. They're not bound by the rigid timelines. The downside: lack of control. Once they submit that file, they're not able to really tug on the strings of the underwriter or have direct contact necessarily on their schedule when they want it. Limited lending products. A lot of products that are available through other channels are not available on the broker channel. And this could be mainly in the jumbo area. If you want to borrow more than $766,000, broker doesn't become such a great option. Again, no control of the appraisal process. They take the app, they send it off, and the wholesale lender orders the appraisal. If they submit it somewhere and you have to change courses midstream, happens from time to time. They might have missed something on the initial package and they need to send it to another place. You have to start all over, meaning new disclosures, new appraisal, new everything. And again, same thing. When things get really busy, the capacity for a fully underwritten pre-approval sometimes goes away. Which brings us to the third option, which, as you can see, this is kind of the pros and cons list I made when I was choosing where I wanted to work. So there's not that many cons on it, but we have good rates on conventional and jumbo. Cross-country mortgage specifically as a direct lender is the largest direct lender in the nation, so we have more options than anybody else. I'm able to shop those options across a wide spectrum. We get a lot of different lending products for a lot of different needs. We have full control of the loan process, meaning that I can get on Teams and just ping my underwriting manager and ask a question. I can reorder the order in which files are being looked at if I have to get docs out or have to get something looked at more quickly. We have our own appraisal management company where we pay the full amount collected to our appraisers, so we get really good local appraisers. We've always offered fully underwritten approvals, even in the heyday of COVID, and we're available on your schedule, just like brokers. The con is on jumbo, when we're dealing with a high net worth individual who has $1 million in the bank, it's tough for us to compete with retail banks because all we do is mortgage. So we can't lose money when it comes to the mortgage, right? We can't all of a sudden go make money on credit cards and wealth management stuff because all we do is mortgage. We're specialists. All good? Any questions on any of that?
I just want to jump in just to reiterate, when I kicked off, I said the listing agents love when they see Faramarz team. These are the reasons why. Like when you talk about contingencies on an offer, offers are more attractive when you remove as many contingencies as possible. In this climate, I'm certainly not suggesting that buyers do that. However, you can feel confident if Faramarz underwrites your loan, you don't need a loan contingency, likely don't need an appraisal contingency either. And these are all things that make your offer more competitive. And the listing agents trust that if his team has said you're good to go, you're good to go.
Thank you. Yeah, but to echo your point, that's not a blanket rule. Every
Not a
deal
blanket rule. No,
must
right.
have the
Thank you.
contingency discussion. Yes, every
Yes, of
file, every
course.
property is different because
Of course. Yes.
So,
Thank you for saying that. Of course.
Then we'll figure out what are contingencies even. We'll have to cover that too.
Yeah.
All right. So I've created this little cheat sheet for you. If you guys want to take a screenshot of this, no problem. I'll leave it up here for a second. These are some good questions to ask your lender. Hey, it's a big deal. Yes, I would love for everybody on here to work with me. That's great. But if you are calling around, if you want to ask these questions, now you know what to ask. Are you a retail lender, broker, or direct lender? Do you meet face-to-face with clients? That's something that we do on our team because we want to get the whole picture of what you're all about. It's not just so much, give me your income, let me see your assets, great, you're approved to this. What does this all mean, right? What does this all mean in your overall picture? Are you about to start a family? That brings a lot of expenses. We want to account for that. Are you about to retire? Are you concerned that your 401k isn't big enough and you really want to put some money there? These are all things that we can cover, and you should be able to get this kind of holistic approach from any lender that you work with, because that mortgage is going to be the largest debt for many of you on this call at the time when you buy the house. Who does your appraisals? What's your availability? If I need you on Saturday or Sunday or at 7 o'clock, are you going to be available? Do you fully underwrite all of your pre-approvals? How fast can you close a purchase transaction? That could mean the difference between getting your offer accepted and not. And how do you communicate during the transaction? Do I always have to be calling you, or is there proactive communication that goes out? We've spent a lot of time on our process and system. We keep buyer's agent, listing agent, borrower, everybody informed ahead of speed on the transactions as things are happening. So you're never scratching your head wondering, where am I in the process? What's going on? So these are good questions to ask if you're interviewing any lender. Once you've gotten to that point, you feel comfortable, then you can apply for a loan and we can go through the pre-approval process, right? And when we're pre-approving people, we as lenders are basically looking at three things. We are looking at credit, income, and assets. So let's look at credit first. Credit is credit score, and it's your credit mix. What is on your credit report? This shows kind of the breakdown of credit in America. For the most part, if you're in those blue boxes, you're going to get the best terms. All right. If you're in these, 670 to 739, Depending on the lending product, there's a big difference between 699 and 700, and that's where we really want to look at your credit report and see, is there something we can do real quickly to maximize your credit score? Because it does have an impact. And if you're 740 or up, you're probably going to get the best terms. If you get down into that 620 to 680, you are going to start to see your interest rate go up. There's not one rate for everyone, because the more risk there is to the lender, the higher they're going to charge you for loaning you the money. So this is it's called a loan level pricing adjustment, and it's just universally applied. Different credit score, different down payment, the type of property. There's all these things that go into interest rates. So there's not just one rate for everybody. And this kind of gives you an idea. Now, when it comes to your actual score, it's important. A lot of clients come to me and they say, I don't want you to run my credit because I'm going to get inquiries and my score is going to nosedive. Not true. Total credit myth. And if you look at what your score is made of, 35% is your payment history, so pay everything on time. Another 30% is based on managing your revolving debt. Not your installment debt, not like a car loan or student loans, but your revolving debt, credit cards and things of that nature. 15% more is the length of time that your credit cards and all that stuff has been open. So if you have these old accounts, remember that secured credit card you gave somebody $200 and they gave you one in college and it's just been sitting around on auto pay, don't close it, because that length of time is helping you, even though you only have a $200 limit on it and you don't touch it anymore. So leave those old cards open, even if you're not using them. Just those three things together make 80% of your credit score, right? And then credit mix, and which is a combination of your credit. Do you have installment debt? Do you have a mortgage? Do you have revolving debt? The more of a mix you have, the better your score can get. And then new credit's kind of a weird one. It hurts you at first. If you open a brand new credit card, a Chase Sapphire card with $20,000 limit, for about 6 months, the world wants to see if you can handle it or not. So your credit score takes a dip. After 6 months to a year, once they've seen that it's active and there's no lates and the balances are staying low, your credit score shoots back up again. And it's actually better than where you started, because you're showing that you can handle that new debt. Inquiries are not that big a deal. They are something, but they're not a huge thing, right? This other stuff is way bigger. And mortgage inquiries are the least impactful on your credit score. So most impactful, consumer debt. Target, Macy's, Home Depot, places like that. The second is credit cards. Third is auto loans. Mortgage is the least impactful. So if someone has a really strong credit profile, applying for a pre-approval and getting that credit run should not be a huge deal. Once we're done looking at credit, then we start looking at the income picture. And you can be anything as long as it's documented income. Wage earner, self-employed, retired, you're 2 jobs, you're a waitress and an Uber driver, you make money hourly, you make money with commission. If we can do it off of bank statements. If you have a lot of assets, I can convert that into income. If you get rental income from investment properties, we can use that. So a lot of people think they don't make a lot of income, especially with inflation. You probably feel like you don't make any income because everything's getting more expensive. But turns out when we look at it, there's something there, and there's something to work with, and there's something we can do. So don't discount yourself because you think your income is low. At least find out. Maybe we'll find out that it is too low, and you might need a co-borrower who doesn't live there, or we might need some other, plan or strategy that we can put in place. But once at least you know what your starting point is and what it is you can do today. Okay. Once we have your income, we look at your debt to income ratio. We look at your gross income on a monthly basis. We look at your monthly expenses, and we make a ratio out of that. So if you make $10,000 a month and your monthly expenses are $1,000, your debt to income ratio is 10%. And if we add a mortgage to it that's $3,500, now all of a sudden we're at 45%. So these are the limits of debt to income ratio for different programs. FHA will let us go to 55%, conventional 49%, most jumbo loans 43%. I do have what we call non-QM products, alternate doc, where they have no debt to income ratio, and these are used for a variety of different purposes. If we have someone with a ton of assets, more than the house is worth, we don't need to look at their income. If we have a investment property purchase where we're looking at just the rental income of the property. We don't care so much then about the borrower's income if we use this one specific program. So there's a lot of different ways that we can slice and dice this. So let's look at an example here. So at the top here, we'll see annual household income is $150,000. Okay, let me get my little laser pointer going here. $150,000 means monthly income is $12,500. Now, if you have no other debt, this number in blue down here is your max monthly payment. Okay, for conventional in this column, FHA over here, and VA over here. Okay. So this basically translates into a conventional purchase price with a minimum down payment, right? 5% down of about $735. FHA, we can stretch it to $810, and VA, we can stretch it to $855. Okay, and the reason we can do that on VA, it's a great loan, 0% down, and look down here, there's no mortgage insurance on the VA loan. So that can go right into your loan amount, which means about another $70,000 of loan. So these are some examples of a $150,000 income scenario. One thing that's just happened that's exciting, just within the last 30 days, in November 18th, is that conventional lending allowed for 5% down on 2 to 4 unit properties. And what that means is that we can do a minimal down payment on a multi-unit building. Ilan's going to show you an example of a triplex that's for sale at the end here when she goes through the listings. And we can use 75% of the rental income to add to your income. So in a scenario where annual household income is $120,000, purchase price is all the way up at $1.2 million, which would normally be way too much. But our rental income on the 3 units that we're not occupying is $7,500. They rent for $2,500 each. So in this scenario, we can get all the way up to $10,615 with that minimal 10% down, right? I mean, 5% down right here, right? So $60,000 down payment gets us in the door on a $1.2 million property, 4-unit property, using the rents to help us qualify. And that's really exciting. That should open up home ownership opportunities to a lot of people. Once we're done with income and credit, we move on to assets. Just like income, this comes in a lot of different flavors. Where is your money? Checking and savings, mutual funds, in your 401k, 401k loan, cryptocurrency, gift funds. Now, all of this is okay. The one thing that is not okay is cash. So I have a lot of clients who work in cash businesses like bartending and things like that have just put their money into safes. And that money needs to come over and be seasoned in a bank account. You can't show up at escrow with a big box of cash. Lenders don't like that. We need to see where the money came from, but we only need 2 months of bank statements. So once you get that money into your account and I don't see the deposit, it's as if it never happened. So if you put your money into your account in July, I can use your August and September bank statements to help you buy a property in October. So if you have a lot of cash, or if your parents or somebody is giving you or gifting you a lot of cash and they don't want to run it through a bank account, then definitely talk with your lender early and get on the same page as to what the strategy is and what the timing is going to be. The big bummer is when somebody refers somebody to me and they say, we just saw an incredible house and they have $300,000 of cash and we want to make an offer tomorrow. Then we're in a tough situation. So the earlier the better on all of this stuff. When we start working together, once we have the pre-approval, we take a close look at our closing costs. This is a sample sheet that I put together that we go through line by line. We don't necessarily have to do that here. It's a little micro, but basically we've got our lending related stuff here, escrow and title here, prepaid items here, impound account here. These are all terms and details that we will cover in great detail at your pre-approval meeting, right? Any lender should be able to go through these things with you in tremendous detail. But this is basically the chunks that they come in. And what that translates into, if we go back to our scenario where we had our $150,000 income person putting 5% down, is that in this conventional column, when we add together all the closing costs, and this is a typical closing cost in Oakland or Berkeley with the city transfer tax, we've got about $61,000 needed for conventional, We've got about 50,000 needed for FHA, and we've got about 25,000 or so needed for a VA loan. Again, 100% financing, no down payment needed for the VA. But it gets better because California has a lot of down payment assistance programs that are available. So if we add that DPA in there, if you look here at the bottom, we've added in these last 3 rows, which is the package that comes with Cal HFA. This is one of the examples. There's Alameda, there's AC Boost, there's GSFA, there's all kinds of different programs out there. But the California My Home loan paired with a California Zip loan, and some of this has to do with income, some of it doesn't, some of it has to be first-time buyers, some of it doesn't. But when you pair these things together, the conventional cash to close requirement drops to $24,000. The FHA for an $800,000 property drops to less than $10,000, and the VA goes all the way to 0. Everything is covered. You don't need any cash out of pocket with a VA paired with down payment assistance in some scenarios if you qualify. So this is definitely something we can talk about at our meeting as well. We'll get all your information and we present you with what all of your best options are. Okay. So this all looks great, but what about the fact that the market's going to crash, right? Is now the right time to buy? Ilan, have you ever heard this from anyone in the last?
Never. No, never. No one ever questions it.
So this is a great question. This is a great question. A lot of people just go with their gut on this. They go with what they feel. I'm going to try to present you with some data that supports that it is probably a great time to buy a home right now. So first of all, rates have gone up, market's going to crash. Well, not so much. Let's look at historical interest rates. We have a weird period here from the end of the financial crisis. Each one of these vertical bars, by the way, these gray bars, indicates a recessionary period, okay? So we had a weird time here from this financial crisis all the way through COVID. An entire generation sat there and saw the Fed funds rate at 0%. Never happened before. And we got used to it. And people can't be blamed for getting used to it. It wasn't a 1 or 2 year phenomenon. From 2008 until last year, 14 years, the Fed stayed at 0. They stayed at 0 after the financial crisis because the other mandate they have is fight inflation, but also maximum employment. And the unemployment rate just wouldn't come down. It stayed up, even though the economy was doing better. They called it the jobless recovery. So they had to keep that rate at 0, hoping unemployment would get better. As soon as it did, they started to raise it. Boom, COVID hits. We're back to 0 for another couple of years. So we've had this weird little run, but now we're back up here in the 7.5-ish zone. But if you look back over history before this gray bar, that's kind of where rates were. And quite frankly, they were higher than where we are right now, and real estate's always done pretty well. So rates alone are not in a bad spot. We're kind of around where we should be, 5.5 to 7.5%, historically speaking. So let's look historically now at the data and what it tells us during an inflationary period, which is what we just went through. Back when Volcker was in, inflation jumped from 7 to 14%. Mortgage rates responded to inflation, not to the Fed. When inflation went up, it drove rates up to 18%. The Fed responded to inflation, slowing down the economy, taking the Fed funds rate from 11 to 20%. Inflation back down because we slowed the economy down. Mortgage rates went back down when inflation went back down, resulted in a big recession. Okay. Same story under Greenspan. Inflation goes up, mortgage rates go up, then Fed goes up and inflation comes down and mortgage rates come down. The important thing to remember here is that the Fed doesn't control mortgage interest rates. Mortgage interest rates respond to inflation. We saw that just as recently as last year. Inflation jumped from 1.5% during COVID to 9.3% last summer. Okay. The Fed didn't start making moves until June of last year. There were a couple of quarter-point rate increases, but those 3 quarter-point rate hikes, June, July, September, November, those were the big ones. Interest rates had already gone up from January to June of last year in response to inflation and the anticipation of Fed moves. Rates had already gone up. So then we peaked out just recently at 8%. Fed funds over the course of the last, what's it now, 18 months, 15 months, 0 to 5.5%. Inflation, it's working. It's come down from 9.7, most recently 3.5% on the headline PCE. Rates should come down as inflation continues to decline as soon as the market believes it's going to stick. Now, what's going to happen to the economy? Are we going to go into a recession? A lot of people think we're already in a recession right now. Okay. That's generally what happens when the Fed puts the brakes on. We're hoping for that soft landing, but we'll see if we can actually achieve it. Now, what happens during recessions to interest rates is rates drop because recession means unemployment. The Fed shifts footing from inflation to fighting unemployment. And you can see here, rates have gone down during every single recession, even our latest one, our little mini COVID recession, rates go down, right? And when rates go down, good things happen to real estate. Now, we're starting to see it. Let's look at what's happened just in the last 90 days. We had a really strong, we were down around 7.1% here beginning of September. We had a really strong jobs report at the beginning of October. The September jobs report that comes out in the first week of October was almost double what the expectation was. It showed a really robust job market and the economy exploding. That's not good news for rates because it shows that everybody's getting hired, wages are going up, inflation is going to kick in. But over the course of the month of October, we had a lot of really negative economic data and downward revisions to that job report. They said, oops, we made a bunch of mistakes. So this big spike that took us up to 8% completely reversed course over the last month here, and we're back down into the low sevens. If this trend continues, we're all looking at Friday. Friday, the November jobs report comes out. If we get 180,000 is the expected number. If you guys see on Friday morning that the economy added 250 or 300,000 jobs, bad news for rates. If we added 170, 160, 150, this trend is going to continue going and rates are going to continue to come down. So that's a big number for us. So what happens to home prices? In a recession, everybody loses their jobs. You must have foreclosure waves and everything. No, not true. Home prices go up during recessions. You can see here every single recession going all the way back to 1960, home prices exited the recession higher than when they entered it. The only exception is this one weird one here, which was 2007. It was a recession caused by the financial crisis. And a lot of people are a little worried right now saying, wait a minute, we had this big spike in home prices. I see this big spike we just had. Are we about to have another home price crash? And the data tells us that we are not. And the reason is, if we compare what's happening now to 2007, back then, lending standards were lower. Average borrower credit score is 751 right now. It was 699 in 2010. We had a lot of adjustable rate mortgages back then that were adjusting higher. Right now, 2.5 million. We had 13 million in 2007, of which 10 million were adjusting higher right at the wrong time when people needed loans and they started to evaporate. If we look at inventory versus then, in the run-up to the great crash, when everybody could get a loan, all you had to do was fog a mirror. The builders responded to this by going crazy on building. They're like, oh my God, everybody can buy a house. Let's build a bunch of houses. We had record inventory hitting the market in 2007. Almost 4 million units were out on the market. We have record low inventory right now, and we don't foresee a ton of houses coming on the market. So this inventory tightness is going to keep prices solid. The other thing that's happened since then, we have household formations have gone up from 116 million households to 129 million. So we have 14 million additional households. We have 3 million fewer homes. These are national numbers. So we expect things to stay pretty nice and tight from a price standpoint. Not great news. I know you guys are home buyers, but as an investment, it is great news because it means that you are protected against some kind of crash in the real estate market. It appears. Now, anything could happen. Nobody knew a pandemic was coming. You know, I don't know who knew that Ukraine was going to get invaded or whatever, but there are a lot of unknowns. But what we see in the data is that the housing market should be resilient. The other factor, affordability. Again, I know it feels unaffordable. It feels like everything's expensive. But if we look back in 2007, This is mortgage debt servicing as a percentage of disposable income. It was at a record high in 2007. Even though prices have gone up since then, because the wages have far outpaced anything else, which is what led to inflation, affordability is now at a record low. So even though it might not feel like it, from a national standpoint, as a percentage of disposable income, affordability is better than it's ever actually been, even though the headlines want to tell you something else, right? Other factor, home equity, is that we have tons of borrowers sitting on a lot of home equity. And yes, recessions suck. People lose their jobs. On average, 1.5 million jobs are lost. But when the Fed goes to fight that and reduces rates, for every 1% reduction in mortgage rates, 5 million new people are able to buy a home. So it's 3-to-1 ratio on job losses versus opening the door to more home buyers. So people will probably not leave the keys on the counter and walk out the door if they have hundreds of thousands of dollars of equity. They're going to sell their house. It's not going to be some kind of mad rush or anything like that. And then the fact of the matter is, if we look historically, don't bet against the champ. Real estate is the champion of investments. Real estate is an incredible 73, 7, and 1 back to 1941 in the win column when you look at appreciation. Now, I know everybody wants to look at that 2007 crisis, but that's a clumping of 5 consecutive years of reductions. If you take out that financial crisis, well, then you're talking about an almost undefeated record of real estate on a year-over-year basis, right? And you might say, well, what about these big gains and stuff in these specific years? If you look at from 1943 to 1947, it went up a cumulative 118%, followed by 43 consecutive years of house prices going up. If you look at 1974 through 1979 down here, and this is when rates were going up to 20%, this 1974 to 79, this little stretch right in here, 93% increase in home prices over 5 years, followed by 10 consecutive years with just a -1 and a 0, followed by another 14 years of positive until the financial crisis. So this is not unusual. Yes, 2021 was big, 19%, but you can see it doesn't necessarily mean that the market's about to crash. This was not because home prices had gone up. This was because idiotic loans were available for every single person out there, and you had everybody from your barber to the person who sold your shoes to anybody who had 5 investment properties because lenders were out of their minds at that time. That does not exist right now. The standards are much higher. And again, reminder, inventory, 2007, 4 million. Right now, 1 million, right? So this is a local snapshot here. And this is a local snapshot of Alameda County, which, and Ilan and I can send this to you right after the meeting, which supports that home prices should continue to be relatively strong, especially if that trend that we saw this last month continues and interest rates go down. Why? Because if we look at this, historical appreciation over the last 60 years in Alameda County is up 6%. Last 10 years up 8.7, and the last 5 years almost 8%. We're forecasting, and this is not me, this is from CoreLogic, that the median home price in Alameda County, which is currently 1.2 million, is probably going to go up 6% per year and top out at about 1.6 million about 5 years from now. That means 6% per year going up. You're going to enjoy a 33% increase on a leveraged investment. The opportunity to make money as rates go down is tremendous right now. There's a lot, and the big reason is this: the demand. The supply side, it's going to be tight. I hate to tell you guys that are on this call looking to go out there and have your pick of the litter. A lot of houses have a lot of loans on them that are very low interest rates without people that are super excited about selling them and getting out of them. Should open up, hopefully, if rates come down low enough and people start looking at that. It also, just out of time and family things happening, you know, it's great. I got a 3.5% interest rate in 2021 when my kids were 2 and 3. But all of a sudden in maybe 2026, when they're 7 and 8, I don't really care so much that my rate's 3.5%. I got to get a bigger house. I'm going crazy here, right? So we need some family changes to occur to open up that inventory. But for now, it'll probably be tight while this big chunk, and I think a lot of you guys are in this chunk, of the population here are coming to the market. The prime home buying ages of between 27 and 35 years old. It's a big bulge in the population coming. Almost 200,000 renters able to buy, right? So it's a big deal. Now, the other thing that we always hear is, why in the heck would I want to buy? I'm renting right now, and if I look at the numbers, I'm paying double what I would if I rented. Valid, not crazy to say that, but let's look at this a little bit more closely. Here's that average median home price of 1.2 million. Equivalent rent for a home of that size right now is right around $5,000. Equivalent mortgage with 20% is about $9,900. So yeah, at first glance, you look at it and say, whoa, why would I double my housing expenses? This is stupid, right? But over here, if we look at the cash flow difference over the next 9 years, yes, it seems on its face to be crazy. I'm going to be out $435,000 in negative cash flow if I buy this house versus just renting and riding the rising cost of rent. Well, let's take a closer look at that. Because of that 435, you're actually paying yourself 132,000. That's principal that you're paying down on your loan that you're actually putting into your house. You're putting it into your own equity. You're also going to be paying about $100,000 less in income tax over that period of time because you own your home and because you get a tax deduction. So that's 230,000 of that 435 right out of the gate. Now, if we look at that forecast depreciation of that 6% over the course of time, even if we take into account the cost of selling your house 9 years from now, which is going to be paying agent commissions and transfer taxes and all that stuff, you actually end up ahead almost $500,000. And this is at today's interest rates. If we can refinance you down to a lower rate in a year, 2 years from now, this number gets a lot closer to 600,000 being generated for you, and you can get on that real estate train just like everyone else is. Okay. So happy to go through all these numbers with you in more detail if you guys have any questions.
I feel like this would be a great time to mention that your team offers free refinancing for anyone who finances with you for 3 years.
Brilliant. Thank you for the reminder. Yes, we have a promotion going right now. If you close your purchase with us, we will do a zero cost refinance at any point in the next 3 years. And so that is, we call it buy now, refi later, but it's basically there. You get a certificate when you close, but you don't have to hang on to it. I've got it in my file here for you. So when the time is right, when rates have come down, refinancing typically costs somewhere around $3,500 with a new appraisal, title, escrow. We have a buy now, refi later where you can get it done at no cost with us. Okay. So that's one of the reasons to work with us. I actually should have put that on the slides, but some of the other stuff just about me real quick. I've been in this business since 2003, so 20 years, done over $2 billion in mortgages. I worked with over 4,000 families with home financing, that's refinances and purchases. And I'm supported by an amazing team. We have worked so hard to build a process that takes care of you, that maximizes your chance of getting your offer accepted, that makes you feel like you're part of the family and you're being taken care of. And if we ever don't, then let me know, because we got something we have to fix, and we're constantly trying to fix stuff. We fully underwrite every single pre-approval. We can close in 12 to 14 days. We can have a discussion about waiving loan contingency and appraisal contingency so that you can waive it with confidence. We'll explain to you exactly what that means when we talk about it. And you get to leverage our reputation in what we like to call the most trusted pre-approval letter in the state of California. I will call the listing agent personally on every single transaction. I will walk them through how we've underwritten, who we use for appraisal, why our offer is going to be the most likely one to close if they accept it and decide to work with us. And I happen to know a lot of the listing agents anyway, and we have tons of data to support it. Some of the people we've worked with are, families like Tony and Maria. We got them into contract in 15 days. They were on a time pinch. We have programs for first responders, nurses, teachers. Tara she works as an EMT, and we were able to help her out with some down payment assistance and get that done in 15 days. And then just like you guys, Tony and Amanda, I met them at a homebuyer event. We pre-approved them, and they got into contract, and they closed in 14 days. So with that, I'm going to kick it back over to Ilan, and she's going to walk you through these are some of her favorites that she picked out here in the local market, and can talk about it.
That was a lot of great information to take in. People have been asking for slides. There will be a recording that we'll send out, so you'll be able to review everything that Faramarz just went over. It's a great time to buy. The best time to buy, I got this from Faramarz, was last year. Every year you can say that. It's just a great time to get in the market always. So I imagine after taking in all of the information that Faramarz shared with us, that you may be feeling empowered to move forward with your home search. And I just pulled a few homes that I've been touring and in contact with some of the agents on that are active on the market now in the East Bay. So this home is really unique. Faramarz made reference to it earlier on in the conversation. It's a triplex in Rockridge. There are 2 vacant units in this, and 1 unit that has had a tenant, I believe, for 11 years, generating over $2,200 in rent every month. It's been on the market for about 2 months. I believe the owner.
Wow, that's really unusual to have. I mean, what a great opportunity. I mean, how many times do you see a property in this market on in 2 months?
Opportunity, like great walk score, bike score. So to have that rental income that's in there for an excellent tenant, it's really remarkable.
Ilan, when you see something on for 2 months, is there a concern that maybe what's wrong with the property? Or is there something hidden that's goofy about it? I mean, what kind of stuff do you do for your buyers when that happens to find out more information?
So I will do a deep dive into disclosures, make sure we understand are there some neighborhood nuisances? Is there a foundation issue, roof? Is there trouble getting insurance?
Right.
We'll do a deep dive into all of that, and so you can feel good. Sometimes they're just sitting on the market because it's not perfect for the people who have looked. And right now, in this market, buyers are looking for perfect. They obviously haven't taken this seminar, this webinar, to realize it doesn't have to be perfect to get into the market. But people right now in this market and this climate are sort of looking for perfect.
Got it.
But this is a really incredible opportunity.
All right. How about this one?
This one, okay, this is one I love.
I can't believe it's Berkeley under $1 million. Is that even possible?
Exactly. Berkeley under $1 million is almost unheard of. So it's been on the market for about 3 weeks at this new price. Had been originally listed a little higher. It is super sweet. It's across the street from Olone Park. It's a 2-bedroom, 1 bath, and there's an opportunity actually to build a 2nd bathroom in the laundry room. So the plumbing's there. It could be a really easy conversion into a 2nd bedroom. Downside with this one is there is no garage or designated parking space, but I've been there a number of times and I've personally never had trouble finding parking there. I've also, when I was looking out with some other buyers, spoken to neighbors a couple of different times who have lived there in the neighborhood for years and reported always feeling safe over there.
That's good.
And I know
can see the listing agent emphasizing biker's paradise. Like, you don't even need a car to live here.
Exactly. And I know the listing agent very well, and I know they are very motivated. So it's a really incredible opportunity to get into Berkeley at this price.
Awesome. Should I flip to the next one?
Yeah, let's go on to see the next one. Oh, this one. So this one just came to market this week. It has not been sitting. It's in the Woodminster neighborhood of Oakland. Great price for 4-bedroom, 3-bath unit, 1,653 square feet. I spoke to the listing agent a lot. I mean, it's really stunning. So there's a front courtyard in it, beautiful views and balconies off of the backyard. There isn't a usable backyard, but there is opportunity to do terracing there. There's also, the listing agent told me, fully built out plans to build out the downstairs there, and you can essentially double the footprint of
Wow.
this home if you move in. It's a really incredible opportunity. The one challenge that I see might come up with this home is, so Woodminster is kind of right by, it's adjacent to Montclair. These are very high fire zones, and I don't know if anyone
So
on
yeah,
here,
insurance is going to be tough on this one. I bet you
insurance is
anything.
really going to be tough.
Yep.
Definitely in this climate, if you wrote an offer on a house like this, you would want an insurance contingency. Make sure you can get insurance at a price.
Yeah, I'd say you lock up insurance before you even write an offer on
Of,
this one, like we're doing on a
yeah,
lot of properties right now.
you would
Yeah.
absolutely, yes, want to do that, or put the contingency in for sure. But it's a really great opportunity, and it's, the inspections and everything are clean. There's like one little area of the foundation that might need some work, and in this climate, that could be the type of thing where we negotiate with the listing agent some kind of
Price reduction or
yeah,
credit or
exactly,
something
some
like
kind
that.
of price reduction. Thank you.
That's cool.
And then lastly, we saved what might possibly be the very best
Steal of the century.
deal of the century in the East Bay. I was laughing because when you showed your home buying journey starting in 2000 at 400, I was like, oh, I have something I'm about to debut in the 400 range. So this is in Richmond. It's a townhome, 1415 Nevin Plaza. It's 3 bedrooms, 3 baths, 1,497 square feet with 2 garage spaces and in-unit laundry. So
This is exactly what I was talking about, Ilan. If you can get because it's a family, it's 3 bedrooms, right?
it's 3
Great. I don't have a
bedrooms.
backyard. I don't have this and that. I make some sacrifices, but all of a sudden in 5, 6 years, boom, I'm rolling, right?
It's incredible. And so this property is one that the city of Richmond has slated for a median income household. So there are some income limit restrictions on this. It's mostly for first-time buyers. But it's a great opportunity so you don't have to be like fully low income. It's a median income house. It's right near BART, Amtrak, and the Richmond Ferry. It's an incredible opportunity. So the theme that I hope everyone's seeing from these few properties that I've highlighted, there are a lot of opportunities out
And
there.
every price point.
At every price point. Of course, there are ones, higher throughout the East Bay, but there are incredible opportunities to be had for people who are ready to start building wealth.
That's fantastic.
Or
It was
or
really cool
investment
to see
properties.
kind of,
Yep.
yeah, it was really cool to see kind of how you go through the property process and describe it and kind of the things you take into consideration from your side. I never get to see that really. I'm the numbers in the weeds of pay stubs and W-2s. It was a nice
Yes, well,
insight. That's
thank you.
awesome.
I offer a full service experience. I'll accompany buyers to their open houses, point out any nuances that you may
Oh,
not
that's
pick
awesome.
up on. I'll bring off-market opportunities as they arise, and along the way connect you with a stellar team of specialists as necessary, so you feel completely supported and informed in your process.
Oh, you're fantastic. That's amazing. Okay, cool.
Thank you.
All right, you guys. So we finally got to the end here. So what are you going to do next, right? So you have 2 options. One, sign off of this, go have dinner, continue doing what you've always been doing. Just go keep renting and living your life. Option 2, fill out the home buyer questionnaire that we're going to email to you, and let's start building your path to generational wealth together. It's a very brief questionnaire. It's going to ask your name, a little, maybe a estimate of your income, assets, and how eager you are to get going on the home buying journey. Please fill it out and send it back, and I'll follow up with you, and Ilan will follow up with you, and we'll start to get you on that path to pre-approval. If you think you're not ready, don't worry about it. Just let's get it started and have a discussion at least. And so there's no pressure, there's no obligation. You don't have to do anything, but it's such a tremendous opportunity. It's a window of time right now. If rates really have turned the corner and are going down, It won't be long before we're back to the frenzy of 2021 with multiple offers, everything going over asking. It's a nice, calm time right now to get in and get some of these houses and opportunities that have been sitting there. So thank you very much, and thank you, Ilan, for including me in this.
Yes, thank you,
Appreciate you.
Faramarz. Thanks everyone for joining.
All right, you guys.
Take care.
Stop recording.